Peter Lynch, Secret Investment Strategies That Beat the Market, Must Watch. When Peter Lynch began work at Fidelity 50 years ago, you could buy lunch for less than $1. You had to wait for the mail to read an annual report, and the Dow Jones Industrial Average hadn't hit 1,000. Much has changed, but not Peter Lynch's boyish fascination with stocks. Looking spry in a dark blue suit, yellow tie, and sneakers, he shared some of his investing wisdom. Welcome back to Investor Secrets. In this video, we're going to talk about what strategy does Peter Lynch use to invest in today's market. So watch the video till the end, because today's video is going to be the bomb. Peter Lynch is a rock star for investors around the world. One reason for this is his extensive writings where he shares, in a simple manner, how he invests. The bigger one is, perhaps, that under his stewardship as fund manager, Magellan returned an astounding 29% a year on average. The fund beat the S&P 500, its benchmark, in 11 of the 13 years, 1977 to 1990, during which Lynch was the fund manager. Read One Up on Wall Street, you will learn what made Lynch a great investor. A core philosophy that was sound, a set of unique tools that worked, and an investing worldview that was grounded in reality, says Aswath Damodaran, professor of finance at Stern School of Business, New York University. Lynch is at his best while giving pointers on how to research a company, plus what should be looked at and what ignored. He also explains how one must classify a company based on market capitalization and the business's life cycle. Most important, he advises investors to stick to their field of competency, something that is also advocated by legendary investor Warren Buffett. Lynch's argument is that a doctor will always know more about medicines and hence will be in a better position to judge pharmaceutical companies than a civil engineer. Similarly, a salesperson with an automobile company will understand his company and competitors better than others and will know if sales are rising and falling before stock analysts do. Lynch's investing strategy also involved placing companies in 6 categories, clearly defining expectations from them. This allows investors to identify the right focus points. The first category is slow growers. These are large companies that have been in existence for long and are expected to grow slightly faster than the country's gross national product. The most important characteristic of slow growers is that they pay regular and generous dividends. They must be included in the portfolio, as a dividend check is always good. The second category is stalwarts. These too are large but haven't lost all the steam. Here, Lynch favors a clear strategy. Investors should buy for a 30 to 50% gain. These companies are not meant to be held forever and should be included in the portfolio as they offer protection during recession and decent returns when market sentiment is positive. His favorite category is fast growers. Lynch says they can generate the best returns, although he also warns that they face greater risk of extinction. These are new, small, and aggressive enterprises that can grow at 20 to 25% per year. Explaining this category, he says, this has nothing to do with the industry. There can be a fast-growing company and a slow-growing industry as well. Another risk of buying the stock of such a company is the steep price fall when they falter. According to Lynch, the trick is to figure out when they will start slowing and what is the correct price for purchase. The third category is cyclicals. Entities in this group, which includes automobile, airline, tire, steel, and chemical companies, see a rise and fall in sales and profits in a regular, if not predictable fashion. While coming out of recession, cyclicals tend to flourish, but investors may suffer huge losses if they buy a cyclical stock at the wrong price point of the cycle. Even though it is said that you should not time the market, in case of cyclical companies, timing is everything. The other 2 categories are companies in special situations, turnarounds and asset plays. Turnarounds are companies that were on the verge of bankruptcy but have been revived. This could be because the government bailed them out or another company made a strategic investment in them. The best example of such a company is Satyam. Asset plays are unique in that they are either dying or are so old that their real estate has been written off their books. However, they have a lot of cash and negligible debt. The tough part is assessing the assets and finding out if the management will allow their liquidation. This requires understanding and patience. Once a company has been categorized, Lynch says it's time to understand the business and reasons for investing in it. For this, he recommends that investors use the product of the company and list reasons it has the potential to beat competition. Though it sounds simple, it is not. But his cardinal rule is stay away from the hottest stock in the hottest industry, the one that gets the most favorable publicity. This simple rule can save investors from the crash that invariably follows market euphoria. If you are not clever in selling the hottest stocks, then you'll soon see your profits turn into losses, because when the price falls, it's not going to fall slowly. nor is it likely to stop at the level where you jumped on, he says. Lynch's other suggestion is to stay away from a company that diversifies into an unrelated business. Lynch calls this diversification. He says investors should reevaluate such companies. Perhaps it's best to book profit in them. He also says that one should invest in stocks only the amount that one can afford to lose, as stock markets can be irrational. He also says that one should invest for the long term, 5 to 10 years or more. He is against leverage and desists from speculation. Lynch also suggests that before buying a stock, an investor should also check the price to equity, or PE, ratio for the last few years to get a sense of its normal level. If the company's PE is high, one must also check the PE growth rate, PEG. Lynch is credited with using this figure to check if a company is worth looking at. He used to divide the PE of the stock by the growth rate and reach the price to earnings ratio to growth, PEG figure. PEG equals price to earnings divided by percent growth of the company. The strategy is simple for investing in stocks, and after investing, regular monitoring at least once in 6 months is a must. Owning stock is like having children. Don't get involved with more than you can handle. If you guys enjoyed this video or think it was valuable, then don't forget to hit the thumbs up, subscribe to our channel, and hit the bell icon to get notified first. Also, feel free to let us know your thoughts about the next video in the comment section down below. See you soon. Bye.